You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, tax time is right around the corner. What are you going to do? Hopefully not make the same mistakes next year that you made this year. And hey, if you have employees, Steve is going to share with you a way to get the employee retention credit that many of you might not be familiar with. And Steve, hey, Moskowitz LLP and tax law firm. Great to have you back on the show, Steve. So
it's great to be back. Thanks so much for inviting me back.
Always. So,
just before airtime, we were talking about something that is really a great help to business people, and there's a big section being overlooked. So let's talk about it. ERC, Employee Retention Credit. This is where the federal government is giving away. It's not a loan. It's a grant. It's a gift. Giving away up to $26,000 for every employee that you had during 2020 and 2021, if you qualify. So you say, well, okay, so if I had 10 employees, I get up to just over $250,000. If I had 20, just up to over $500,000, and so on. So you say, well, tell me already, what do I have to do to qualify? So there's two ways to qualify. One way is what I call the easy way. It's called the gross revenue test. And under the gross revenue test, if your gross revenue dropped by a certain amount, that automatically qualifies you. And this is done, the calculation is done by quarter. And the government wants to give away the money so badly that they amended the law to give away even more when they said, well, if you qualify for a quarter, but then you don't qualify for the next quarter under this test, that's okay. There's something we call an extender, where basically if you qualified for quarter one, that automatically qualifies you for quarter one and the next quarter, quarter two. So you say, well, that's terrific, but what if my gross revenue didn't go down? And here is just a crying shame I've seen over and over again. Remember I told you there's two tests for this. The easy test, that's where your gross revenue goes down by a certain amount. But a lot of the firms, a lot of the CPAs are stopping there and say, well, if your gross revenue didn't go down, that's it, no ERC for you, goodbye. Wrong. That's not what the law says. The law says either or. There's the objective test, that's the gross revenue test, your gross revenue going down by a certain amount, or a facts and circumstances test. Sometimes it's called full or partial closure, but basically what it is where COVID restrictions adversely affected your business by more than a nominal amount. IRS thinks nominal is 10%. So I said, well, wait a minute. What if my gross revenue went up? How could the COVID restrictions have adversely affected me? I made even more money. The answer is because if it had not been for the COVID restrictions, you would have made even more. Well, it's very true.
Yeah.
So let's take a look at a lot of businesses had the restriction that you could only use part of your premises. So suppose, for example, wherever you live in the country, your state or local government said, you know what, you can only use, well, first of all, when the pandemic first started out, they say everybody's closed except essential businesses. So, okay, you qualify for that period, no brainer. But then they say, well, you could reopen, but there's some restrictions. And even on essential businesses like the food stores. For example, the food stores here, like all businesses, they could only use 25% of their capacity. So literally there was a guard at the supermarket, and once there was 25% capacity in the store, he wouldn't let anybody else in. You had to stand in line outside, wait until somebody came out of the store, and then he'd let one more in. So the bottom line is that would be considered a 75% partial closure. And you take a look at, you say, well, there's all kinds of things that can happen here. And you say, well, wait a minute, that's a big one, because suppose, for example, I go to my local restaurant and I say, hi, I'd like to have dinner tonight. And they say, well, sorry, we're already at 25% of capacity. And I say, all right, well, I guess I'll go down the street then. And I go down the street. That's it. That restaurateur, even if he made more money because he raised his prices or whatever, but he still lost out on that sale. That's what this is talking about. And there's a lot of variations of that. For example, if you otherwise qualify for the supply chain restrictions. Suppose, for example, you're a manufacturer and you need raw materials to make your products. If you can't get the raw materials, you can't make the products and you can't sell what you don't have. It costs you business. And a lot of times people are saying, well, my revenue went up because their costs spiked so much that the gross revenue went up, but they lost business. But again, go back to you can't sell what you don't have. Another situation is where you can't get the products that you need. So suppose, for example, you have a restaurant and normally you serve Coca-Cola. But because of supply chain problems, you can't get Coca-Cola. Now, if you get Pepsi-Cola, you can substitute. But what if you just can't get any soda? And you say, well, I have to sell the food, but I just can't sell any soda. You lost business because of that. Other things, suppose because of the social distancing where you're staying so far apart from each other, you have less workers working on the line. So they're making less product or sorting less fruit or anything else. So you now, because of COVID restrictions, you have less products to sell, even though the price is shot way up.
Right.
And for example, I have a client whose unit cost went from $7 to $22. His gross revenue shot up, but he lost a lot of business because of COVID restrictions. Or another situation where, let's say your client installs hot water heaters, and normally you can get the hot water heaters right away. But because of the COVID restrictions, now he can't, supply chain problems. He'll say, look, I'm not going to wait all that time to take a hot shower. I'll find somebody that has something. I'm just not going to wait. I'm not going to do it. He lost business. So the bottom line is we're looking for anything that's going to qualify. And again, there could be all types of things here. Now, what you have to watch out for is you say, well, wait a minute. How come so many firms are not getting to this second area? Because it takes so much more work for the professional. Let's compare and contrast the two methods. The first method, a certain drop in gross revenue, that's math. 1 + 1 is 2. That's the right answer. Everything else is wrong. So if you have that drop, no brainer, nothing to think about, you qualify and that's that. The second method can take a lot more work. For example, people that qualify on the first method, that's just, you can qualify somebody in just a few minutes. It's just so easy. The other method, it's a lot more work. For example, I have some clients that we had to have multiple meetings. And why do we have multiple meetings? Because I gave them homework. And they came back, but they didn't bring enough homework with them. So I said, okay, this is a start, more homework for you. And they had to do sometimes multiple times of homework. But it's worth it. And the reason it's worth it, because if you qualify, you get a lot of money. And let's talk about that. The ERC is even really better than the PPP was. You say, oh, wait a minute, I thought you couldn't get both. When this law was first passed, you had to choose between PPP or ERC. One or the other, not both, make your choice. When, once again, the Congress so badly wants to give away the money that they said, well, you know what? No, they amended the law and you can, although you can't double dip, the fact that you had PPP does not stop you from getting ERC. Mm-hmm. And you say, well, okay. With PPP, it was a mad rush because the Congress set aside a certain sum of money and said, that's it. And when the money runs out, program's over. And I remember the PPP was just a giant rush. Who could get there before the money ran out?
Sure.
They didn't do that with ERC. ERC is general treasury. It's an unlimited fund of money. Another reason ERC is better. With PPP, it started out as a loan, and then you had to swear that you used the money for payroll and rent. ERC, there's no such requirement. It's basically, you can do whatever you want with the money. You could put it in the business if you wanted, or buy some jewelry or go on vacation, do whatever you want with the money. So the bottom line is, and again, I've seen case over and over and over, and I'm friends with some CPAs, and I was a CPA before I was a tax attorney. I've asked some of the people, I said, why are you doing this? And they said, the other way is just too much work. I said, but okay, I understand that, but the thing that bothers me so much, it's like if you have a medical problem, you go to your doctor, and they're sorry, no cure for you. You would be really, really, really mad if you found out there was a cure, but your doctor didn't do it, so he told you there was no cure. What he should have done was say, hey, I don't do this procedure, the second procedure, but Dr. Smith down the hall does it, or I don't know who does it, but it's available. Find some doctor that does. They're just telling people no and moving on. So that's why it's so incredibly important. If you've been turned away for ERC, Employee Retention Credit, because you were told, oh, your gross revenue didn't go down enough, you want to talk to us about, do you qualify under the other method? And again, like everything else, not everybody qualifies, but an awful lot of people that did not qualify under the gross revenue going down do qualify into this method. Now, on the other extreme, you want to watch out for the Johnny-come-latelys, because there's a whole bunch of companies that popped up. They're not attorneys, they're not CPAs. There's brand new companies that popped up and have decided to go in the ERC business. For them, everybody qualifies. And that's a problem because there's a lot of fraud there. Obviously, you don't want to go to somebody who excludes you because you're too much work for them, but you don't want to go to a fraudster either. So the bottom line is, you want to go to somebody like us that, we're a well-established tax law firm. I've been in tax practice for over 30 years. Mm-hmm. And we will tell you if you qualify. If you do, great. If you don't qualify, we'll tell you that too, but we'll tell you why. So the bottom line is this government money is out here, and the government is just giving the money away. If you qualify, and a lot of employers do, let's go ahead and get the money. Suppose, for example, you own a corporation and you have one employee and it's yourself. Can you qualify? Yes. And then you say, well, is there a limit to this? If you have more than 500 employees, there's a different rule. But if you do, you most probably have somebody doing this for you. But if you're just a regular business with between 1 and 500 employees, you really want to talk to us about this.
Okay, but they have to be W-2 employees, right?
W-2 employees, right.
1099s.
No 1099s, W-2s.
Okay, fair enough. What's the maximum amount you can get? You said $26,000 per employee.
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
It's up to $26,000 per qualified employee. So basically, you multiply 26,000 by the number of employees you have. Now, that's the max. Most people don't get the max. But, we've had clients, and again, the numbers are all over the place. There's some people who just don't qualify. We've had other clients who literally receive multi-millions. Lots of clients that received hundreds of thousands and smaller amounts. But again, it's free money. So if you qualify, by all means, you should get it.
Yeah, there's nothing wrong with free money, right?
Well, you earned it. Look, the government has bailed out big business. We see that all the time. Finally, the government is doing something for small business, and that's what this is all about.
All right. Well, that's nice to...
And again, the government defines small business as 500 employees and less. To me, that's pretty big, but that's their definition of small business.
All right. Well, hey, so it's in the eye of the beholder, I guess. So what else is available? Are there any other pandemic-related...
There's all kinds of things available. For example, an awful lot of business people miss out on a pension deduction. You say, well, Steve, here it is. It's April the 3rd, 2023. And I know with most tax benefits, you have to write the check by December 31st, 22 in order to deduct for that. But pensions are an exception. And I use the term pensions and retirement accounts interchangeably, although there are some technical differences. You have up to the time of filing the return plus extension with a lot of the plans. And again, there's over 20 of them. And with the plans, you basically say, I have a long time between now and the extended due date to set up the plan, put the money in, and then you decide, do you want the money to apply to 2022 or 2023? And this is something where, right now in year 2, you can do something and still deduct it from year 1 if you want to. That can be a big tax savings. And there's 4 major benefits to a pension plan. 1, you pay less taxes. Most people at that point say, hey, terrific, sign me up. 2, your pension earnings are not taxed while they're in the plan. So no brainer, if your pension earnings are not being taxed, your fund grows a lot bigger and faster than if you weren't paying taxes. 3, we have the benefit that I told you about where you can be into the next year but still deducted from the previous year. And 4, there's special federal protections that if you get sued, and people love to sue business people, if the jury awards an amount in excess of your insurance, they can't touch your pension. And although I hate to mention his name, the biggest example of this is O.J. Simpson. O.J. Simpson has had a multi-million-dollar judgment against him for many years, and he's not lost 1 penny of his pension. So that's something that's a big deal. Another thing we want to take a look at is cost segregation analysis. If you're a landlord or you use real property in your business, you get to write off a portion of that every year through depreciation. You say, that's fine. Now, if it's a residential property, you get to write it off over 27 and a half years, and a commercial property, 39. And you say, well, either one of those, I'm waiting quite a while to get my benefits, unless you employ cost segregation. Now, with cost segregation, what happens is you say, okay, you have an acceleration of depreciation. This takes advantage of the time value of money. That's how the banks make money. $1 today is worth more than $1 tomorrow. So if I said to you, Kerry, would you prefer to have a benefit today or 39 years from today? I'm sure you'd say I'd rather have it today.
Yeah, who knows? 39 years, I could be dead.
Or the tax law could be different. But even if you're alive and the tax law is the same, if you save those taxes now, that's money you could invest, and you have a whole bunch of income on money that you otherwise would have given to the IRS this year. So what happens is with cost segregation, it greatly accelerates your depreciation. What if you already have the building? You say, I've owned this building for a while now. That's okay. We can do what's called the change in accounting method. So this is how, by doing some of these things, this is how people oftentimes wind up paying so much less in taxes that people don't know about this. We all see the Fortune 500 companies making incredible amounts of money and oftentimes legally not paying any taxes. How's that possible? It's possible because there's 2 purposes to the tax system. We all know about one of them is get money from us. But the other one is a system of incentives. What if the government wants you to do something that's good for the economy? By the democracy, they can't order us to do that.
Yeah, not yet.
Not yet. So what happens? How does the government get us to do something they want us to do, but they don't have the authority to order you to do it? They pay us. They pay us through the form of tax relief. That's how you can wind up making a lot of money but not paying the taxes. And you say, well, another example, going back to cost seg, suppose we have this situation. Suppose we have a brain surgeon and she's married to a house husband and she has a rental building or she practices medicine in the building and her gross revenue is more than her expenses, including regular depreciation, by $1 million. So she's got $1 million profit. But then she employs cost segregation, and now we have an extra $1.5 million of depreciation. We don't write a check. Depreciation, it's an accounting entry. So with the $1.5 million, we wipe out the profit on the building. So even though we have $1 million more in the checking account, we're not paying taxes on it. But we still have this extra $500,000 of depreciation. Can we offset that against other income like wages, profits from a business, dividends, interest, things like that? The answer is, although as a general rule, your accountant will say you can't do that because that's a passive activity loss. It's Internal Revenue Code Section 469. There's an exception to that.
Real estate professional.
Real estate professional. So with real estate professional, with our example here, with a married couple, only one person has to qualify. So if hubby becomes a real estate professional and he otherwise qualifies, then we take that extra $500,000 of depreciation now left over. We offset it against the wife's surgery income, and we see how this couple made $1.5 million and didn't have to pay any income taxes on it. I could go on, but we're probably running out of time, and you get the idea.
I get it. I think you got some good strategies here, Steve. So just tell us, where do we find you? How do we connect with you on the internet?
You can either call us at 888-TAX-DEAL. That's 888-TAXDEAL, 888-TAX-DEAL, or MoskowitzLLP.com. MoskowitzzLLP.com. That's MoskowitzzLLP.com. Thanks so much for inviting me. As always, had a great time.
Pleasure. Hey, if you got a question for Steve, you can always shoot me an email at kl@kerrylutz.com. Go to the show notes of this interview on financialsurvivalnetwork.com. You will find Steve's link. Click it, take you directly to his site. Steve, appreciate you coming on. We'll talk to you again soon.
Always a pleasure. Thanks so much. Bye-bye.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.